Okay, so my talk this morning is going to be about actually incorporating some of the themes that we've heard so far from the speakers. So thank you for the great insights. Um, we have a thesis at Blue Ridge that deal making is going to be harder and harder, and track records are getting a bit compromised these days. I have some data on that later in the presentation. And we're seeing in this deal activity, there's usually a few outcomes. You get the underwriting case, that's a success. Many times you don't discover many issues until it's too late and it has a direct impact on your IRR or your MOIC, depending on what metric you're most interested in. And we're seeing it's harder and harder to get to the upside case. And we think that that has a lot to do with delaying go-to-market and commercial effectiveness activities early in the hold period. You know, deals, Pavan said, deals are hard enough. Sometimes it's needle in the haystack to get it, right? And Peter also mentioned that a lot of PE investors, you know, they don't think like operators, right? They're super smart and they're making lots of money for themselves and LPs, but they're not naturally oriented to understand the key levers in growing a business. And sometimes it doesn't happen until late. So we see it's getting harder and harder. And we see that there's a few outcomes. In the current diligence process, we have the traditional stuff, market diligence, you know, commercial diligence, Q of E, operational diligence, ESG, specialty diligence, technology, et cetera. And we see the value of Q of E, which is a staple in diligence, right? Give a backward look on the financial health of a business. You don't want to buy an asset until you understand that it's a sound business, right? So that's a very important piece. Second, you need McKinsey, Bain, BCG, or LEK, Parthenon to understand what the industry growth rate, because it's a bet, right? American football, we got Super Bowl coming up in a couple of weeks, going to be a lot of betting. I mean, private equity, they're betting all the time, right? And you're either going to be alpha to the industry growth rate, or you're going to be below. And that has a direct correlation to whatever your outcome is going to be and your future success for fundraising down the road and continuing that process. So these are vital, and we believe that they obviously are required, but we think that it's insufficient. We did a survey late last year, and we got feedback from over 100 deal professionals of firms with AUM of at least 2 billion. Most of them were in the upper middle market, large cap space, but we think the middle market was well covered. And 40% of deal partners said that they don't have an effective pre-close process to address go-to-market and pricing issues. So do some math. I think it was Pavan 1258. That was the deals last year. So 40% of that, that's 500 deals where that could mean that there's potential risk right out of the gates because they're not a deep dive on, you know, what the growth potential can be, and more importantly, how you're going to get after it. So a little bit more detail on the survey results. Really interesting. You know, they definitely want a better view on go-to-market and pricing because they think it could enhance returns. Look, the name of the game is conviction, right? That's the big bet. It's the lead investor going to the mat, making the case at investment committee to say, this is a good asset and we should get behind this thing. A lot of work to do to get there, right? But the more that they would know about the potential and the conviction that they could at least achieve the underwriting case, but more than likely get an alpha to that case is something that's super important. Also an independent view. There's 3 data points in a deal, right? It's the banker's view. It's blue skies and amazingness, right? It's going to be all awesome. This is an incredible asset. There is a deal team point of view, right? An incredible model. But the same analysts that are doing bad outreach on selling that Peter mentioned on, you know, buying a deal, they're also the ones that are doing the underpinnings of the model, you know, with a VP and a principal, and because we understand the sophistication of how deals are done. But at the end of the day, it's someone that's grown up through investment banking and private equity that has not had a commercial lens. So everything that they're doing is just building hypothetical models based on information, right? So it's really hard to get a view and a stake in the ground, what is an independent perspective on what that asset growth trajectory will be. Pick a 5-year hold period as typical. What's that going to look like? And then the other thing is, these are all competitive deals. This is about stacking your money higher than somebody else. And in order to do that, you better have some pretty good conviction that there is some uncovered growth that other folks aren't seeing. So we see that the QoR is also a strategic advantage for firms that are doing it. But again, super hard. So what is QoR? It's a forward-looking lens on the potential of an asset and also giving this independent 3-year revenue forecast. I was an operating partner at the Riverside Company in the microcap fund, and I led the commercial excellence team. And I did lots of diligences, but it's a sprint. At best, I'm spending 2-person days over 3 to 4 weeks. Reading the sim, reading the management presentations, prepping the deal team for our first management presentation, all the follow-on work, diving into the data room. What kind of red flags, yellow flags are you seeing? And then how could you wrap that up into some insights like good deal, bad deal? Like, it's really hard to go deep on a model. I mean, I've been doing this stuff for a long time, but even that, it's really hard to get really unique insights. So that was call it 16 person hours. The effort that I'm talking about is 450 person hours to do lots of modeling, leveraging some AI to an extent, but it's more about deeper data analytics behind it to give that perspective. And at the end of the day, we're trying to help these sponsors be successful. So what does it do? Pricing is a tried and true lever in value creation in private equity, but it's kind of scatter. If you look at a scatter plot of what firms are great at it and not so great, it's a wide spectrum. We see lots of opportunities typically because particularly for growth businesses. So pick a SaaS business, it's already making money, it's on a nice trajectory, but they are all so focused on top line growth that the discipline of pricing is usually not something. It's very product oriented, as it should be. Is it a differentiated and scalable, sustainable business and offering? So pricing is usually not something that they spend a lot of time on. So we dive into that. Looking at sales performance. Again, back to what are you looking at? How believable is that pipeline? The first year is the biggest bet in the whole hold period. Can that management team, assuming you're probably going to make some changes to that management team, could all that turmoil manifest into hitting your target in year 1? You got to have a really good view of that going in order to be successful. So that's pipeline data, win-loss data, lead management data, lead scoring data, like all the interconnections between sales, marketing, and then getting a data view of how believable that forecast is going to be. Poor economic stability. LTV to CAC is such an important metric here. And oftentimes we see that it's just too expensive to get new customers. And you got to have a good point of view on that going in to understand what knobs you're going to turn to get an LTV to CAC in a reasonable range that you feel is the right ROI and getting the right outcomes. Then it's your team. How can you validate the competency of the team to be able to scale at the level that you need to? So we usually see a lot of CRO, CMO turnover, certainly CFO turnover in growth businesses, even in middle market. But you need to be able to kick the tires on them beyond just the typical screen. This is going much deeper about their patterns of producing top talent across the organization and not having concentration where you're only having a few reps that are crushing it or a few channel partners that are killing it as well. So this is all again, we wrap this up into a data view to get an understanding of the commercial engine. So let's just assume you're successful. There's a great party and everybody's high-fiving. Founders are psyched because they just made a lot of money and hopefully they want to stick in, keep a fair amount in the game still so they can ring the cash register again. There's a lot to do. There's priorities that are stacked higher than you could imagine, but you're on the clock. right? How do you rationalize all the things that you need to do against an organization? So let's just say there's 30 things you want to do, right? And you could argue that maybe on the go-to-market growth side, there's 5 or 6 things that you should do. But what are the 3 that are going to move the needle the most that you could go toe to toe with the deal team and the management team to rationalize that? You need to have that answer on the first day that you're walking into the value creation plan. In most businesses, it's something that gets pushed off. It's like, hey, we're growing fast enough. Industry's growing already at a good, healthy rate. Team seems reasonably good. We have bigger fish to fry, and we're just going to go, get to go to market later. The problem that I've seen, particularly being in that shoe, because you're already now thinking about your add-on strategy, right? So you're 12 months in. Now you got your first meaningful add-on, you got your ornament on the tree, and you're trying to figure out how that's going to be, expanding your TAM, giving you an opportunity to grow the business. But now you're seeing some signs of forecast inaccuracy, right? All of a sudden, second quarter in a row, you missed your number, and now you're looking at people, there's some attrition, and all of a sudden the world's upside down. And you're like, damn, if you looked at the foundational elements of those things, they probably could have got teased out a lot earlier. And now you've lost 12 to 18 months in the hold, and just say hello to a declining outcome in terms of achievement of alpha, and then putting that underwriting case under risk. So what does this mean? It means clarity of focus. If you do this look of the go-to-market function and the potential, it's about just getting your ducks in a row and looking at where we should spend time. I think the biggest area that we see issues, and I saw this as an operating partner, it's usually just conviction and discipline around your ICP, right? TAM, SAM, SOM seems pretty well understood. It's part of the investment thesis. Everybody gets it. But connecting the dots and pulling the thread on your ICP in your demand gen activities, your sales development organization, your coverage model, your channel partners, scoring all of your marketing investments against ICP A and B, not just overall outcome. This is one of the things that is really, I think, not as well understood as it should be. And it's something that most companies don't do very well at. I think the other pricing I mentioned, and I would say cross-sell, upsell, especially when you start to do your add-ons, right? Now you're 2 years in, you've got 2 substantial add-ons, maybe, in formation or already in. Now you've got this big integration issue. It's data, systems, people, markets, all this stuff going on. And one of the things that we see, while there is a lot of excitement on the deal team and the management team on the potential, executing against that is usually terrible. What does that mean? That means that when you come up with your growth strategy and your budgeting process for, let's just say this year, because you were planning it in Q4, how much specificity is there on your best customers and your best prospects? Are you putting your modeling right into your budget assumptions, right into your sales team's quotas, and then lining up all your marketing activity, and again, your sales development and your sales motions to hit that? And then are you scoring the management team against that? Is that part of the monthly operating review? Is that part of the quarterly board meeting? And usually it's not. And that's one of the frustrations that we hear often, especially now we're kind of like getting into the latter half of the hold period. And there's still a lack of evidence that cross-sell, upsell, opportunity that you had so much excitement about, and you want to take ultimately into an exit story, is not manifesting. Again, we think that happens by getting that right very early in the process. And then this is about rationalizing priorities, because the resources aren't unlimited, right? You've got to make choices on where the impact could happen the most. But unfortunately, a lot of folks don't do that great. So why is this important? We think for PE firms, it's going to give you a better view on the business. It's also, again, in this competitive world, it should give you the potential to identify these upside opportunities and give you more conviction. We're live on a deal right now with a very highly regarded investor out of Boston. It's a software business, not that big either, only 30 million in ARR. And we had our readout on our QoR last week, and the principal that's on the deal, he said, all right, time to flip the tables. Why shouldn't we do this deal? Like, all sounds great. We want to know, we're going into finalize C on Monday. What's your perspective on, is this a good deal or not? You can't answer that question unless you have, spent a lot of time on the business, spent time with the management team and have a good idea. The good news is we think it's actually a really good asset. They look like they're in a very good strategic position to get the business. And they're excited about it. So we're hopeful that there's going to be a nice win for them. For bankers, I mean, it's a big deal. It should be able to justify higher valuations, right? You're talking about having higher quality assets being taken to market. And if you have this type of rigor, it's something that they should get excited about when they're trying to market it to all the sponsors. And then ultimately, we're already talking about this live deal of the kick, assuming success for everybody. Within the first 2 or 3 weeks in the hold period, we're going to do a full workshop with the entire management team to basically convey all the opportunities that we see in the business, because they're excited about it. Most of them are going to be sticking around. And we think this is going to be a great opportunity for them. And now you're going to see just basically getting alignment around these 3 constituents that are really important. So it all sounds great, but why don't people do it? There's a lot of expertise that's lacking. Look, it's a sprint. I think one thing I've learned about investors in working with private equity firms for the last 15 years and working for one for a few years is that they're risk averse. As much as they're willing to write a big check, they're risk averse, right? And if you start looking at what's a new part of their process, sometimes while they know they need it, they're not willing to maybe make that change because it could be a principal sponsoring their first deal and they don't want to upset the apple cart or do something different. The team's hustling. There's a lot to do, and you don't have a lot of expertise on this type of content. And there's a real concern with spooking the management team, right? If this is a high quality asset, it's a competitive process. They're not looking to exhaust the management team with just like the 15,000th request for information that likely is already in the data room, but the sponsor's too lazy to get after the right information, so they keep pinging the management team with all these terrible questions. So there's this thought that hey, sounds great, but we can't do it. We've cracked the code on that. We think that the structured data request that we give is effectively all assets that should be in a data room to begin with. So it's nothing too taxing. We think that external experience is really important, bringing folks that know this stuff and helping the deal team to understand the opportunities. And we don't see it as, we don't need more access to the management team than anybody else does. So that we need one interview, and we usually do that like the 3rd week of the process. And it's something that's really, really good. So let me give you an example of why you would do this. So this is software business that we worked on. Market growth rate from the market study was 12 to 15%. And the deal team was like, look, we're not going to try to go too blue sky on this. Could we grow at least at the upper rate of that and maybe a little bit incremental? And how should we think about that? Our modeling showed that we thought that the CAGR should be 21%. We had a lot of conviction. There were a lot of fundamental things that they weren't doing in the sales organization. We see that as something that's pretty typical. They had hybrids. They had like literally a round robin of leads coming in. It would just go to you're just next in line. You may not be the best salesperson, and that may be like our best prospect coming in the door, but it was your turn, so you get to close them. Like, that's not really a scalable process for businesses. They had one SDR doing kind of just reactionary inbound, but we felt that there was still the potential for a lot of outbound, and we built a capacity model, truly understood that there would be a 4x return on that SDR time. So basically 100K should turn into 400K, and we had a lot of conviction, and we felt that they should roll one out every quarter until we got to like kind of a saturation point. So again, very much aligned in where's that ROI and where's it coming from. And then we felt that it was a pretty quick process to do a trial, but there was no follow-up and there was a lot of improvement that they could do. So again, these are not rocket science things, and you would figure that any good management team should be able to, do this stuff. But when you're in the moment and there's 15,000 other things to do, these are those fundamental foundational things that usually just leak out, and you want to make sure that you could do that. Pricing was a big opportunity for them. They had 3 tiers in their market, kind of their tier 1, and they did a price increase last year, and it was really interesting. It definitely affected new logo acquisition. So the deal team was very concerned with that at first and said, hey, great. We didn't spike a lot of churn with that price increase because we really amped up our customer success activity on our best customers. So I think they managed that process really well. But for the folks that weren't very prepared and enabled to have that conversations with the new prospects, their win rate was tanking. And that was a big concern for the deal team. They say, okay, great. We had all this new logo, we were cranking, and all of a sudden price increase, boom, it's plummeting. Do we have pricing opportunity down the road? What does this mean for our new logo acquisition? Because it's a huge part of our growth plan. And we went and did an extensive modeling exercise. We felt like, look, the folks that were churning, here's all the data to show that they probably weren't really your best customers to begin with. They were behaving like that because the revenue that they were contributing was really good, but the characteristics weren't good. So they were churn risk anyway. You just didn't see it. And that's something super important by, again, understanding your customer base and all of the data behind it that shows what is that, what is the true ICP. And then marketing, some quick wins. They were spending a reasonable amount of money. Their LTV to CAC was okay, but we felt that there were some short-term things that they could do. And also in the next 6 months, some kind of table stake things that weren't too expensive that could really help drive the growth. So at the end of the day, we had conviction that we could actually see a path to get to 28% CAGR. Now that for a deal team that was really only wanting to try to do 15 to 17%, that was really frothy. And we feel like it was very defensible, but it may require too much of an investment, for them to get there. So anyway, just having that view and having it that when we do this, we're sparring. Like we're going with the analysts, we're going with the VPs, we're going with the principals and say, okay, here's our data, here's your data, here's your assumptions, here's our assumptions. And by the time we get to the 5th or 6th level down, we're usually in a good spot to say, okay, that makes sense. You guys have went a lot deeper on this than we did. So they were super excited about it. Look, at the end of the day, every IC memo that is going for final approval has a revenue bridge on the asset, right? We're paying X, we're intending to sell to, for Y, and that is something that we A, think we can achieve, B, we'll get our LPs super excited about, and C, we see potential on top of that, to make, more money for the firm and for the management team. But the reality is, if you look at the trailing 3-year data, MOIC is plummeting, 40%. And again, just North American private equity. And LPs are absolutely restless because they're not getting any distributions. So they're not getting their money and the returns are starting to suffer and people are not happy, right? And, just look at the last few years. Cost of capital went up 500 basis points in a matter of months. Private equity firms were not prepared for that. Underwriting, investment cases did not, they thought, the free money train was going to keep going, right? How disruptive that was. Like when I was at Riverside, plenty of quarterly, we're marking our assets and looking with our valuation companies and going, deal by deal by deal. You start seeing a display of here was the investment case, here's how we're trending. Now we got to go fix that. There was a lot more gaps to the, that were not good than there were gaps that were things were going good. So this is just the reality of, how hard this is. Trying to get to the investment case, we think could get bolstered by doing this stuff. And certainly if you're going to get alpha, the only way that that happens is if you're either, sometimes luck happens, which is great, but let's not let serendipity be part of our investment strategy. We have data modeling deals now for maybe 50 of these efforts that we've done over the last 4 years, that we're starting to see a trend. A lot of the very few exits have happened because again, the period is still short, but we're starting to see the models looking very positive to get, at least underwriting case, but more, I'd say at least 30–40% of them that are in alpha range, which is, really exciting. And that only happens because you're making those moves early in the hold period. So again, why do you do it? Greater conviction in bidding. You want to get a faster start to growth. You want to take downside risk off the table. And you also ideally want to compress transformation, get to a better outcome, and get an early exit. So we think that this is, again, a missing piece of diligence. We think that the competitive markets will kind of almost warrant this, and not never necessarily for every deal, but we think on the deals that are meaningful for a fund vintage, particularly new fund launches where they're going to, where at least 2 or 3 of the assets are going to be of vital importance to what that, the returns are on that fund vintage, or when the kind of the organic sales requirement or the reliance on a large sales force versus a, product led growth, type of opportunity. We think this is something that's really, really significant. So it seems to be very, something that all the many deal partners are wanting. And we have a view that this is something that will become more mainstream in the next, year or two. So Pat Donegan, I'll be around, also with the other speakers, and hope you found something, interesting, at least a nugget or two. So thank you.